Hello and welcome to another episode of Fund Friday. Your host, the Director of Business Development with Lone Star Capital, Craig McGrother, alongside a very special guest. Today, not only has he been one of the longest partners, but he's becoming a friend of mine, and then obviously been a friend of Rob and the teams for some time. The one, the only, Rick Martin, the principal and founder of Fortress Federation Investments. Welcome to the show.
Wow, I like that introduction, man. That is one of the better introductions I've ever had. I appreciate that.
Well, on this show, I really want to have a lot of people that not only would be good, interesting guests, but people that we actually have a relationship with. And we've been going back and forth, have done several deals together, just with me being here. And then prior to me being at Lone Star, you've been one of the original kind of partners and co-GPs with us through the whole process, bringing a lot of, equity and investors to our opportunities. So we're very appreciative of that. Getting into, that side, what were you doing before getting into real estate in the capital raising world?
I don't know how far you want to go back. I could take a long time, but I'll just go back. In more recent history, I was in the post-production field in Los Angeles. That's what brought me to Los Angeles. So, um, there are different terms for it, entertainment advertising. So I was doing campaigns for like film trailers and show opens, and working for clients like ESPN, NBC, Fox Pictures, a lot of different clients here in Los Angeles to work with. But actually, all the while I was doing real estate on the side as a side gig, side hustle. Um, and it was sometimes glamorous, sometimes cool. You meet some people, some famous people and whatnot. Go to some fun parties, but the hours were pretty brutal. And a lot of that time was spent on computers in dark rooms without windows. And um, man, I remember driving home the opposite direction of rush hour because I was actually coming home at 6 a.m. From a day where I'd started at whatever 8 a.m. So the hours could be really unpredictable, really brutal, and kind of inspired me to, break free from that and get into real estate.
Right. So basically the want to get into real estate and capital or capital raising probably was out of probably interest, of course, financial freedom and obviously long-term benefits, but then of course to kind of get out of that realm of not really having control as much of the hours, you would say.
Oh yeah, no question about it. You know, there weren't healthy borders that people respected. I'd get messages at 11 o'clock at night. Hey, can you get on your computer and take care of this? Kind of just a weird industry that way. And the more I was getting, I got my lifestyle changed. I got married. I got kids, and um, my first boy, as he was growing, I wasn't getting to have much time with him. So that was a big driver there. And I mean, quite honestly, capital raising wasn't on my radar at all. It was more like I was just getting into real estate. At that time, I was doing, just individual deals on my own. And sometimes I partnered with people. I guess those were sort of the roots of my capital raising, bringing in a private partner. I don't know if that was legal. They have all these regulations how you can bring private investors in, but yeah, I remember doing a couple duplexes out in Palm Desert, California, and having a partner, that helped out with some of the finances and whatnot.
Cool. So then you get into real estate investing. What was the first investment that you made in the real estate world? Was it your personal residence? Was it an investment property somewhere in, a random place in America? Kind of tell me about that story.
Yeah, so I grew up in Seattle, Washington, and I attended the UW, University of Washington. Graduated from School of Business there, but had dreams of being a rock star or a musician. The Seattle scene was exciting at that time. I was a
Was it
musician.
was it the grunge era?
Yeah, I was wearing flannel. No, I really I rebelled against the flannel thing, but yeah, it was an exciting time. rubbing shoulders with some of those more talented people who did make it. I had my dreams, but I I think what happened was the writing was on the wall. I was tired of being a starving artist. I was actually playing jazz gigs in little clubs in Seattle and not getting much more than a few bucks and a meal, maybe a beer if I was lucky. And so I was still I was having to work jobs. I wasn't so crazy about the jobs I got out of business school. They felt a little square peg, round hole, if you know what I mean. But was able to put away some money, and yeah, I bought my first residence just with the intent of living there. But after I got tired of the starving artist thing combined with working days, I wanted to make a change. So I ended up going to film school, which got me down here in LA doing that post-production that I talked about. Um, but I bought that house planning to live there and stay in Seattle, but I went off to film school, and rather than selling it, I rented it, and I was like, oh, these rent checks are supplementing what I'm doing here quite nicely at school. So that's when the light bulb went off. And then, you know, I was still kind of a student with debt and whatnot, but I had this plan where I was going to continue to, at that time, I was just very simple, buy a single family house per year. And that didn't really come to fruition because I didn't often have the money, didn't know how to raise money, didn't know anything about creative financing. Bigger Pockets was definitely not around. Um, and yeah, that was the first one. And then in terms of, making a shift, I did my first out-of-state investment in Vegas, but it's a long story.
Yeah, so with that said, you make me think of something interesting, which is what was the education process like back then? I mean, not that that was forever ago, you're not, a dinosaur by any means.
Oh,
You're
I'm
very,
a dinosaur.
yeah, you're very hip. But what was the educational information like? Because now it's very obvious. You can go to YouTube, there's more information, more kind of blueprints than ever, and more resources than ever to help people kind of, create their wealth and their freedom. Maybe arguably too much out there where there's so much noise, it's hard to really pick a direction and angle. But did you just intuitively kind of get to that? Or like how did you at that point discover that's kind of was something that you wanted to do? And, what was like the blueprint that you followed or you heard about?
That's a great question. No one's ever asked me that. I think, if I have to remember back, I hired property management at that first place, and I would speak with them a lot. Sometimes I would complain to them. I didn't think they were doing a great job, but the owner was actually, he had that sort of investor mindset. Um, and gosh, I didn't even, think about apartments or anything like that. I was just thinking about single family homes. Um, I had an uncle who was pretty successful in commercial real estate, although he's more on the commercial retail, commercial industrial side. But we were always talking shop. But it wasn't like I was digging into real estate magazines. It was more the people that I would come into contact with who were also involved in real estate that knew a bit more about real estate than I. The first people I partnered with knew um, more. Like they were the ones who, inspired me to get into small multifamily, like duplexes, fourplexes. But yeah, it's a great question. We didn't have any resources like YouTube. You didn't even have the internet, um, and cell phones and all that. So completely a different time, and you just kind of scrape for your info. Now, had I been more serious, there were books published and syndication existed, but I had not tapped into that yet. Really, I grew a lot more quickly once, the internet came out and like Bigger Pockets, it's not that long ago. But that really got me into out of state investing and building my network and all that.
So when did you start tuning in and kind of discovering more? I mean, as you said, syndication was around, but it feels really as if the last couple of years there's been a huge push to the private investment side, private equity space. Obviously, that's what you do. You raise money from, your investors and network and whatnot. When did you kind of learn about that and kind of have a light bulb go off as that would be something that you would want to do and, to take it seriously from a career perspective?
I think, well, I went from a fourplex or fourplexes to a 12 unit. And I was just thinking, okay, I'm gonna get as many doors, personally as I possibly can. And that I think was around it was 2015. So quite a bit of time had passed by. I had up until then I've been doing like single family, small multifamily. Um, the 12 unit was actually quite a bit of work. And I, those are my early tastes of finding out that, I don't think I want to be an operator. It was, I was directly interfacing with clients or excuse me, tenants. And it sort of drove me to uh, start to network more. And the more I networked, again, I'd never even really heard of syndication. It wasn't until probably 2016, that I started hearing about that. And then I started attending local meetups around here in LA, then discovering uh, more out of state. I'd already invested out of state. I invested in Indianapolis. That's where kind of my focus was. And then ended up meeting my first operator, who I invested with passively also. And he brought me in on a deal in Columbus. And then I was like, okay, I see how this works. Still intimidating at the time, and still trying to figure out, okay, do I want to be an operator? And if not, what's the other hat I'm going to wear and contribute to this?
It's very interesting because as an operator, I know very well that I would not want to be an operator in the sense that I, of course, have an interesting angle within, the Lone Star team, of course, where I'm relationships, I'm, controlling the capital stack, doing a lot of the introduction conversations, current relationship, servicing, and then new ones, of course, and making sure that I have a pulse and everything. So I kind of do, a lot of senses what you do just directly into our deals. But to that point, thinking about doing property management and handling those moving parts, and really the dirty work and the meat and potatoes of the execution of value creation is something that I just wouldn't want to do. I'd rather just go out, meet people, raise the money, do it that way. So I respect the fact that you knew very quickly that's what you wanted to do. And similarly to myself, there's just no way I'd want to do that. And people ask me, oh, well, do you think eventually you'd want to leave and do your own company? I'm like, absolutely not, because I don't want to do
Hmm.
this. I don't want to do that. I want to do exactly this. There's so much money to be made there. And, it's also at some point, making more money is not going to solve for the one thing that we're all looking for, which is, of course, time freedom and the optionality to have, be able to do what you want to do when you want to do it. That's really what we're all looking to do. It's just figuring out the medium to get there. So, with that said, transitioning from having your own holdings, do you still have deals that you hold yourself right now, and you still have real estate investments that are long term other than your primary residence, of course, maybe some single families? Do you still have kind of the initial deals that you bought and have held them over time, or have you kind of traded in and out and kind of just did the value creation with the value add plays?
Yeah, I've traded in most of those for syndications, a little more hands off. It's even the small stuff is work, and your return on equity diminishes over time. And some of those I had had for a while, so I thought, all right, this is the time to sell this, to grow, so I can get into something that's going to, hey, double my money in 5 years. That's what everybody aims for, right? They don't always get there, but that's the goal. And I think people will buy people say, oh man, I'm rich. I got my personal residence and look how much it's worth now. But they'll look back and it'll been, 10 years before they've doubled their money. It just kind of depends. Now the last 3 years have been nuts since COVID. That was quite a hike up since then. But overall, um, you can get more aggressive with commercial multifamily because you can actually increase that net operating income, whereas you can't with your single family. Um,
Yeah,
so
pretty rigid with single family, right? I mean, ultimately, it's a very, very, and which is nice because it's very predictable. But when it comes to single family houses, hey, it's comparable set. If you buy a track house and an area where the X comp is here and here for 32, it's really hard to overcome that. There's only so much you can really squeeze, and that market's very efficient. But as you know, there's a lot of inefficiencies sometimes with these multifamily projects where you can get a very good basis on these deals. Maybe it's a mom and pop owner who haven't, updated the rents in a while, or smaller deals, whatever it may be, where there's a ton of value to be created to your point there, which I think is, interesting about the equity creation in the 5-year period versus the 10-year part, where if you do the forced appreciation situation where, you improve it and then you kind of flip it, that's where, the acceleration of equity can come into play to your point. And I know Robert Kiyosaki talks about this. He says he doesn't want to hold real estate for more than 7 years. So be
Mhm.
curious to know if that's kind of how you see it as well.
Yeah, that's the way I see it. Me and Robert, man, we're like that. Um, but you made me think about something, a conversation I had it was a Christmas party a few weeks back, where I have a friend, and mixing, people say, well, how do you get started with capital raising? Oh, friends and family. To be honest, I don't. I'd rather not raise from. I would rather not mix business and pleasure. Sometimes, hey, you have a great opportunity, and I'm like, hey, sis, I'll tell my sister, you got to get in this deal. But for the most part, I can sense from a lot of my friends they're a little uncomfortable. They thought, well, what if something goes wrong? They don't say this, but I think it's unspoken. What if something goes wrong? Well, this guy, he was going to invest with me, but I never pushed that, right? It's entirely up to them. I never, they know what I do. If they're comfortable and they want to do it, that they can come to me and I'll be happy to help them. But he decided to go on his own, and I hope he's not listening. He won't listen. Um, he invested in a house. I won't say where. But I was digging a little information out of him, and I found out it was a basically a turnkey property. And I just I didn't want him to be misinformed. I didn't want to say, hey, you should be investing with me instead. I actually had a deal that was going to give him better returns. Because he didn't understand that forced depreciation thing. You get it, you go buy a turnkey, all that value that's created, that's not yours. That's the turnkey operators. So now he's dependent on market appreciation in a market, by the way, that it's not it's a stable market, so it's not going to appreciate a great deal. He'll probably get cash flow, but he's not going to get that upside. So I don't think he's even going to earn, I don't know. I don't think he's going to earn even 5, 6% after my conversation. But the worst thing is he's not going to get that upside. Whereas, you know, if you invest in the right syndication, now cash flow is more challenging these days, but there are ways we know, you and me know, that you can create some extra cash flow. And if you're lucky, maybe you get a deal with 8% cash on cash. That's what we were getting back in 2018, 19, right? And you got that dream of the double in your money, the once we sell this thing or refi, get your money back. Either way, there's that upside. Whereas with him, I don't know. And it's tricky because he's my friend, right? It's a slippery slope, but I did want to advise him without appearing that I was like selling him on what I had to offer.
Well, and sometimes, because when you spend so much time in the weeds in this, it's clear as day to you, but others may not see that. And, unfortunately, when it comes to real estate investing, your dollars are not always going to be treated the same. And effectively, as you just mentioned, when someone goes in the turnkey route, yes, there is you're going to get basically market beta, which is basically what the S&P 500 has to offer. Now, real estate is a little more competitive because you can likely get some tax breaks, whether it be, cost segregation studies or being able to deduct interest payments or, whatever it may be. There are a lot of creative benefits to real estate investing, but when you get the turnkey, it's just it's one dimensional as opposed to making it 2 or 3 dimensional with the route you can take that equity with regards to improvements and whatnot. So it's better for someone to invest in real estate than not. But to your point, it's like, oh, well, these are the opportunities we're seeing right now. The juice is about to be very ripe with regards to the opportunities that are at hand with what's coming up here in the next probably 24 months. And the gap could even be smaller than that. But to your point, yields are going up. The markets are a little bit depressed right now compared to they were before, which is healthy, I think. But it's unfortunate there is a little bit of meat on that bone there for sure. Segueing into the first time you raised for a deal, how long ago was that when you made the choice to not just invest in it as an LP, but now you're working and kind of delegating the really important key, upside and, equity appreciation to a group like us or another group, right? How long did, or when was that? And what was the deal profile when you did make your first raise?
Yeah, capital raising, it was, yeah, again, it wasn't even really on my radar. I was still trying to syndicate, just trying to decide what hat I was going to wear. And back in, it was prior to COVID. Well, I got to go back farther. It's actually that first property in Columbus. I did several different things. I just didn't raise money on that. I did other things to contribute to that. I
You
haven't,
were a true co-GP.
yeah, and I had a marketing background, so I helped out a lot with that. Um, but in terms of like actually bringing investor dollars into a deal, I would say it was late 2019 when I started. Well, I created Fortress Federation 2019, knowing that I wanted to create content and just educate people on real estate in general. And I was writing, I'm a bit of a writer, so I was writing blogs. And somebody who'd read one of my blogs said, "Hey, I love the stuff you write. We do syndication down in the Southeast. We should hop on a call." And we did. And I found out what they were doing. They had a team, and I think there was another person I met right at the same time at a conference, 2019. Um, Developed those relationships, and then finally got the call right at the same time from both people. "Hey, we got a deal. You wanna get in on this?" And I said, "Yeah, let's do this." And this was literally days before I believe they shut down the NBA and the NCAA to the tournament, and all hell broke loose with COVID. And then we all got shaky and scared, and we pulled out of both those. I pulled out of both those deals, but then soon enough, one of those groups reached back out, and it was 2020 that I actually raised some money. And it was hard. I brought in friends and family, a colleague, and I don't think at that time people were responding. Like I was actually sort of developing a list with my blog writing and whatnot, but those people weren't ready to quite invest at that time. But yeah, that was my first step into the raising capital world. And it was, of course, I didn't raise as much as I had hoped. And it was hard, but yeah, it was my first taste, and that's what got me started.
That's awesome. And what type of deals do you typically raise for? Asset classes? Are you agnostic? Are you, solely in multifamily? And you obviously, as you mentioned, have only been really in the housing from the investments that you've basically spoke on this show, but I'm very curious to know what do you typically raise for, what the profile has to look like, and all things of that nature.
Hmm. Yeah, I'm staying in my lane. I know a lot of people, a lot of capital raisers, are pivoting into different asset classes, like whether it be oil and gas or whatnot. And I understand that. I firmly believe in multifamily. It's not going anywhere. And it's what I know and it's what I enjoy. So I'm sticking with that. And I try to keep it basically B class and above. I've done some C class. I actually work with an operator. That's his wheelhouse, and I trust him, and he'll do a good job with it. So I listen to him. But for the most part, I stay in B class, done a few A class, but prefer that pocket of B class. And in terms of other asset classes, I always keep my eye on stuff like self-storage, not so much mobile home parks, but I think commercial industrial seems interesting, but I'm not there yet. The part of the value of, having me um, as the person your point of contact is, I understand multifamily real estate. I'm not gonna raise money for something that I don't understand. I think it would be very tricky to pivot into something without being just immersed into the education of it all.
So do you think if you were to kind of branch out from multi, you'd probably have to invest your equity in there first and kind of see how that goes and really understand, from an engine, basically the engineerings of it, if you will, the nuts and bolts and how, the equation works, if you will, before you would ever raise for something?
Really good question. And yes, and I invested in an oil and gas fund. Actually, it's a more of an oil and mineral rights fund. I've invested in an ATM fund. Um, and then I've invested in another fund that is not going well. And
Okay.
in fact, that money's all gone. And it's been a window. And what it taught me was, real just stay to the tried and true real estate. Some of these alternative investments, I just feel some of them get into trouble. So hey, it's good for me to test the waters, see how bad it can be, see the true downside risk before I ever want to bring it on to my investors.
Absolutely. And we were just talking about this before, but just with the conferences, like, hey, I always feel such a level of having to really perform because when I go to these conferences, I'm away from my email. So I have, of course, delayed you from getting the important investor questions answered. But on top of that, it's, hey, I'm spending Kent's and Rob's money here effectively because that's really what the firm is. It's their money. So I better, bear some fruit and, bringing back a fish so to speak, with regards to, conferences to make it efficient. And, it's funny. It just is a little bit different. And similarly, I really do look at other people's money differently than mine, if that makes sense. Like I'd rather lose my money than someone else's, right? So
Oh,
that's
heck yeah.
just that's just my thought process there. When you do, look for a real estate investment and when you raise for a deal, what do you typically look for? Do you have kind of a theory? It seems like you obviously like, the value add approach as opposed to just more core plus turnkey asset, as we alluded to earlier. I mean, obviously, if you're getting a deal for, or buying anything that's turnkey and it's a good price, that makes sense. But generally speaking, what do you look for? What gets you excited when, many people obviously spam your inbox with offerings?
I think what I start with sort of like, well, for sure, I have to know the operator. I have to have that relationship. So that is established. Some people, y'all get calls from operators that I don't know, and yeah, we have this deal. I'm like, yeah, sorry, can't do that. I have to have a relationship with that person, and that means I've met them in person, and we've gotten to know one another, and I'm comfortable to move forward. So all that sort of like taken care of. But in terms of what gets me excited, well, first I do dive into the sub market. And we could talk about some of those metrics, but in terms of a deal itself, like healthy cash flow, I know a lot of people are doing new development. I like a deal that it's existing structure that's cash flowing because investors can really kind of gauge how it performs right from the get-go. Whereas with new development, they're waiting a couple of years and like, where did my money go? Um, I still love cash flow. It's high on my list. I like lower risk business plans if possible. Nothing too aggressive. And if it is aggressive, it's got to match the local tenant profile. You can't be, you know, putting mother of pearl plated toilets in, like a blue collar, demographics bathroom.
You're not putting marble countertops off Bendera Road in San Antonio, is what you're telling me.
No, we're not. Although I
Yeah,
would like to paint those cabinets white, by the way, Craig. I don't know if I told you that, so we could talk
fair
about
play.
that
Yeah,
offline.
yeah, naturally.
But that's about as far as I would go with that. Um, what else gets me excited? It's exciting to be, in the path of progress. I it doesn't have to be, like some deals, hey, they're not sexy, but as long as the numbers work and they fit the demographic, great. But if I find a deal that happens to have something exciting, something uh, a new development in the area that people are excited about, or like a new hospital being built, or people say, oh, there's a Amazon logistics center. That's a couple hundred jobs or whatever. But that you see new development going in there and you could be a part of it. There's always that upside. It's not a guarantee, but it gets me excited about the upside of a deal. And then one of the things I look at is if there's a large delta between current rents and market rents, then it kind of tells me, okay, there's a lot of value that can be captured here. And then what did you say? Nervous? Did you say
Yeah.
that? What makes me nervous? Um, I guess the opposite, aggressive. aggressive business plans, um, aggressive debt structure, you know, uh, like an aggressive LTV, um, aggressive rent growth, like where do these numbers come from? And if they're projecting that, where's the data that supports that? And then, gosh, how do I put it? Just demographics that I've just had bad experiences with. That like the first thing I do if I'm researching a deal is I analyze the submarket, and part of that is all the stuff like the average median income and um, the demographic and if it's a high crime area, it's just probably not worth it. So those types of things make me nervous.
Absolutely. We said something that I really like that you said there, which is, when you meet someone and work with someone, you have to meet them in person. And or just generally make you feel better about everything, and the sponsor and whatnot. You're not just gonna, get a cold email and work through that there. So I met with someone who was a big institutional player in IMN in Laguna Beach just 2 days ago. And I thought it was really interesting. He's like, yeah, we get deals all the time from seemingly good people, but if I just haven't met them in person, it's just really hard to distinguish them and have a frame of reference. And there's no real starting point other than a cold email. And it was refreshing to hear that because I think doing, stuff as they say IRL in real life, going to conferences, meeting people, going to meetups is really just the gateway for anyone if you're a sponsor or if you're a capital raiser or if you're an LP to kind of have the synergistic setup with regards to meeting people in the space and to really doing business with one another. So there's really no substitute for that. And then once you get those people, just maintaining them. I think we do really put a large point of emphasis at Lone Star with making sure that you feel like, you're treated correctly and that you're heard from and that you're included in anything, especially whether it be, you coming out for the deal we have in San Antonio together to come out and to see the property and, for us to take you out of it and, make sure that you feel appreciated and whatnot. So that's, really big for us here at Lone Star to make sure that that is felt on your end. And then also just a good reminder there to once more, heard it from the other gentleman, hearing it from you. It really just so refreshing and so powerful to, yes, be in person with people, meet them, have that frame of reference, have that action point, and keep doing stuff, keep reaching out and really cultivating, harvesting the relationship. But also, it's fun because the relationships will, transcend just the real estate there. Ideally, right? There's got to be a little bit more substance there. I like, and the people we get to work with, I tell Rob this all the time. You're obviously in this bucket, of course, we can't, but we get to work with really fun people that I would just want to talk to if we weren't talking to do with real estate. So we get very lucky, and hopefully, maybe that's something that you look for at sponsors. It's people that are just normal and good people as well. So I'd be curious to know if that is a factor when you do kind of talk with people.
Oh, without a doubt. I mean, essentially, I've sort of become friends with the operators that I've worked with, and when I'm talking about meeting people, it's better if it becomes like a one-on-one situation. Like even like with Rob, he lives on the opposite coast. And I'll never forget our first conversation. Like we were talking on the phone about me, potentially working with Lone Star. And he said to me, well, I get a lot of these phone calls and they're excited and then I never end up hearing from them again. So, and I'm like, yeah, well, we'll see. And sure enough, he called me and we started talking about a deal. And I can't recall, but he came all the way out. I can't recall if it was before that or not, but he came, no, I believe it was after we'd done our first deal together, but he had come out um, to LA and we had lunch and it was our first like one-on-one. And I think that's much better than like a conference, just because conferences, you're bouncing around from person to person and some people have agendas, they're talking to you and you see their eyes scanning the room. Okay, who am I going to talk to next? I don't really like that vibe about conferences. If at a conference, I totally suggest if you're vibing with someone, schedule a dinner or a lunch or something, especially a dinner. I think dinners are cool. Dinners are more fun. People tend to kind of schedule their agendas going to a conference, but if you're not going to be able to find them, in their own city, their own environment, try to get some one-on-one time with them because that's really when you get to know people and they're going to be more relaxed, let their guard down. And same goes for investors. When I was in San Antonio, by the way, the night before we did our work at the property and drove the market and had dinner and all that fun stuff, the night before I met with a investor who invests with me at Fortress Federation. He lives in San Antonio, so it was a golden opportunity. And we went out, and we had barbecue and hung out and just got to solidify our relationship that much more, you know.
Yeah, it's important. And, the markets are too fluid and there's just too many talented people out there. Lone Star Capital is not the only group who is buying Texas value-add multifamily housing. So a way to really make yourself not a commodity and to transcend past that is to actually care and take an interest into people, not for selfish reasons, but you should just do that, just generally speaking, because your life is going to be more enriched naturally with good relationships. So it's cool to have both ends of that. I do have a question too, and you mentioned this, and I actually don't know the story. How did you get acquainted with Lone Star Capital? How did that happen? Because you got in with us super early. So A,
Hmm.
thank you for being, one of the pioneers and pivotal pieces to help us scale. But then B, what got you comfortable about just Lone Star? Because it's not easy to say yes to a group who's really new and, going through, their first couple of deals. I imagine you're probably kind of in that probably at least the first 5 deals. I mean, we have 17 in the portfolio now. So you've really seen for the most part, the whole story kind of take off, right? So be curious to know how that kind of all unwounded and the backstory and the origin of that.
I think Rob's visibility helped. He was definitely getting out there. I knew about Kent. I Kent's awesome. I like talking to Kent and catching up with him, but the person that you see um out there is Rob. I talked to you about this. I give Kent a hard time. I'm still trying to get him like, come on, man, come on a webinar, go on a podcast. I want to see you out there. But he's the behind the scenes professor, right? And I get
Yes.
that. Rob was, I was like, Rob was he was really young at that time. He's still a young guy, but I mean, he
He's
was,
very young still. And I still get asked all the time, oh, wow, are you 22? You just graduated college? I'm like, I'm 29. I'm almost 30.
yeah.
I actually have gray hairs coming in. I don't know
Oh,
if you can
good.
see the grays, but
Oh,
I do
good.
grays. Okay. I'm
Hmm.
qualified.
Yeah. Yeah. No, I was shocked when you told me you're 29. I just learned that. Rob is what, 28 now or something? I don't know.
He's 26.
Oh my God. Yeah, so God knows how old he was when I first met him. He he was young, but he was sharp, And I think I loved underwriting, and I was dabbling into different models, underwriting models, I think. I'm really trying to pull here, you caught me off guard, but I think that was it. I think I I know that somehow I ended up on Lone Star's investor list. I was getting their deals in my thing. So I must have like subscribed probably to get his Lone Star or his underwriting model. And then I was seeing their deals. And I believe what happened was I saw some sort of invitation on, hey, if you're interested in, not only investing, but partnering with us as well. And so, yeah, I picked up the phone and we had a rather lengthy conversation that first day, and totally two different guys, man. But we've always there's a certain connection there, and understood each other. One thing is, you can post on your website your founding, principles of the company, and that was one thing the more and more I got to know him, I was like, okay, this guy really does live by his principles. And same goes for Kent, and now I'm getting to know Dasha. She's awesome, Um, all you guys. I'm sort of getting to know, I mean, they're team members that I don't know, but Josh, whatnot, I think it just takes time. People say, how do you vet an operator? Well, it takes time, man. Like, and you got to kind of shoot from the hip a bit, you do have to take some chances. But there are things you can evaluate someone's intelligence, I believe, because in real estate, something bad's always going to happen, and a lot of bad things happened this last year, and a lot of bad things are happening out there. So you want to make sure that you're operating with someone who's nimble and can adapt and is, smart enough to come up with contingency plans, A, B, C, and D, because something different is going to happen the next time. First it was the mortgage loan crisis last time, then COVID. Like who could have seen that? We all knew interest rates were going to rise, but were they going to get jacked up over twice what they were? I mean, the forward curves weren't telling us that, we were going off what the really smart people were telling us. So things blindside you. And I think that's sometimes people forget that, investors forget that, passive investors, like they're people, hopefully, if you're with the right person, they're going to do everything they can to make sure that your investment's going to survive. And you can't say that about your stockbroker, like he'll be like, well, sorry, Netflix took a dive today. Not much I can do about it. This is sort of an intimate environment, really. Like I know my investors. I know that you have a lot of investor conversations, those people. And so that makes you fight for it a little bit more, a lot more. Yeah.
No, without a doubt. And the beauty of it is, and I understand why they say it's a relationship business and why people want to do business with people that they've known for a long time, because you're probably a little less likely to burn someone if it's a deep relationship where there's family ties, where, your family name is really associated. If it's, somehow your dad's this, that knows so and so. And well, it's like, well, you don't want to shame your last name, obviously. And then obviously someone before, there's a certain sets of respect and importance that should be associated with that. And if you don't feel that way, you're probably more likely to be a sociopath than not, which is, a topic for another day, of course. And people like that are out there, unfortunately. And there's a lot of people in this business that you wouldn't want to do business with. And maybe you've done deals with them before and like, yeah, one and done, never again. So that's kind of the nature of the game. And what we aim to do is, hey, you're not going to invest with Lone Star Capital probably every time, because it's not probably responsible to only invest in Texas multifamily. But with that said, when you think of making an allocation into Texas or raising for a Texas deal, all we can hope for is to be the person you would want to go to and partner with. With that said, when you do, you obviously get hit up a lot with regards to, you're present, you're out there on LinkedIn, you're out there in other social medias, you have your blog, you've been educating for some time. People come to you all the time with deals, wanting you to partner with them, wanting you to bring equity. How do you vet a sponsor or someone that you work with?
Gosh, kind of what we talked about. I mean, really, I think if if I was I know everybody that I work with really well. All right. So how did that happen? I sort of, I some relationships I sort of fell into, like one operator I work with, he's here in the LA area. So we've met a bunch, we've been in the same room a ton of times. We've gone out, we've hung out. Trust that guy, I know what he's all about. Um, I'm trying to think of this third group that I found. How did I meet those guys? Um, Actually, someone suggested to me, um, that would you like to raise for this deal? And of course, I wasn't going to jump at it, but I did at least reach out to them, have a meeting, and they were cool guys, and we just kept in touch. Now, you know, I, I would I would say don't invest with someone that you haven't met in person. Personally, I don't. It's just like it's just not as you just don't get that vibe or create that vibe like that we had. Sitting in San Antonio having that dinner. You don't you you don't get outside of the real estate realm. Whereas if you're hanging out, you can talk about people's families and what are you into sports? Oh, you got a kid. You start getting to know people on a human level. So I really do believe meet people in person. But if it was me, and I'm vetting a sponsor, which I do, I ask them, hey, can I speak with some of your investors? And I'll call on investors and have conversations, see how their experience has been. Same goes for other partners. It doesn't have to be even be a capital raiser. It could be a property manager, people that they work with. See how do they treat you with respect? Do they give you the what you need to succeed? Are they, do they have a tight wallet? Are they well capitalized? Um, and then I get numerous references, and then I'd like to, I would check actuals versus projected or pro forma, just the history on that, see how they're doing. If they're not performing, dig in a little further. Why is that? Um, and then, as I've discovered this past year, there are some bad apples out there. So I know that background checks, like legitimate background checks, are expensive. But man, save yourself the worries. Do the background check because people do have criminal background. Uh,
No
I
barriers to
can't,
entry really to real estate too, frankly, might I add.
what's
So
that?
no real barriers to entry to real estate too. So that's
Yeah,
why background check in this world is really important. It's not like for, people who are qualified to get a, CFP or, a Series 7, this, that. Like that's an intense process. But syndication, oh, you have some money, you want to do a boom boom? Okay, great. There's the deal. It's very, I mean, it's not easy, but it's easier.
yeah. It's funny, investors will call me and they won't ask me for references, and I'll be like, you know how most people say references upon request. I'm more like, here are my references. You should check me out. And of course, we tend to give people that you have a good relationship with. But one thing I can say is, like, we had a deal this past year that it's been a challenge, and we're pivoting, we're doing what we can to turn it turn into having a successful ending. And the thing is, man, I got right on the phone and I started telling people what's up and continually giving them just updates as to what's going on because I've learned people do run and hide. This past year, especially, you kind of saw that. And, even those people that are they're on a deal that's not performing as advertised or as projected, uh, I can hear the appreciation in their voice, just like reaching out to them and keeping them updated. And it, so yeah, I don't know. That's a lesson in another on another topic, but transparency, man. And that, I guess that works. There you go. Like when you're checking out an operator, get those early signs, those early red flags on transparency and communication.
Absolutely. What assets do you think are going to do best coming up? Naturally, you're probably more biased and skewed to multifamily. Is it certain markets that you feel really bullish about? What do you think is going to perform very well here? With obviously the reset. I mean, naturally, the basis of a multifamily deal right now will be pretty sweet. I would say for the next 24 months, should you buy correctly, which I'm sure the groups you're working with, like us, are doing so. But with that said, what do you think will do very well here, I guess, in the short term, 5-year horizon?
Well, since I'm not a commercial industrial pro, I'm just going off the data that I've read, whether it be um, Marcus and Millichap or CBRE. That seems to be the front runner, commercial industrial. But again, I don't understand it. You'd want to go to a commercial industrial operator. Um, but it's funny. Second behind that is commercial multifamily. It's going to have a short window where it's going to struggle a bit, but everybody kind of knows it with the oversupply, and then there's going to be a nice runway coming. So I do feel I'm still bullish on multifamily. I think I'm definitely going to continue to stay in my lane and work with what I know. So yeah, I'm two thumbs up for multifamily.
Good. Well, with that said, what also on the other side of the coin, do you think assets will struggle the most? What do you think has, I mean, obviously office is very distressed in many places for all the headlines we've all seen, but is there anything that you would say you think will struggle a lot more than you think or more than the average person would think? What's your kind of 2 cents on that?
Yeah, you hit on it. I mean, the thing that makes me most nervous is commercial office. I, I, I wouldn't have the courage to jump in there. I think you have to really know what you're doing. Retail still makes me nervous, and not just because, maybe we're heading up on a recession, who knows? Um, it's just a different world now, with Amazon and e-commerce and all that. I just don't feel secure with either commercial retail or yeah, definitely office is an issue. I think there's been a bit of a recovery. People are heading back to the office, but still talking to a lot of people who are 100% remote. Yeah, some people are at least hybrid, but yeah, that's going to take a while. And people say, well, you could convert those that office to residential. Not so easy to do. So,
I think that is said without a logical idea as to the amount of effort associated to convert that there. And there's a reason why some of these old office buildings are basically getting priced as land value because people know, hey, it's really not easy to force that situation because just how the buildings are structured, piping, so on and so forth, plumbing. It's not easy. It's really not easy. Also, a lot of places and offices are wide enough where what you're going to put a unit inside the middle of the office that gets absolutely zero natural sunlight. Well, who
mhm,
the heck would rent that unless you really have no
mhm,
options? So don't
exactly.
think it's going to be as easy as people say it's going to be for sure. With that said as well, is there any markets that you wouldn't invest in or touch? I was just, as I said, I'm at Laguna for the millionth time, but I was just there, and people are pretty market agnostic. I've never spoken with so many people who will invest in California, that will invest XYZ, because so many people that we work with are trying to, leave those states for the reasons of growth and, rent control and such. But would be curious to know if there's any markets you would just won't touch. The only one I heard was just Detroit, Michigan. They'll never invest in there. And I think he was kind of saying it as a silly way, but he probably truly would not invest in Detroit. But with that said, that was the only city that really people said, no, we won't touch.
Um, I live out here in a blue state, but I probably would stay away from the blue states. I've had, plenty of issues with regulations and rent control and evictions, and whereas there was long delays even in Houston, Texas with COVID. We're talking 90 days, but in Seattle, Washington, you're talking a couple of years. So that those states I just don't feel comfortable. And also, like I mentioned earlier, I like cash flow, and it's tough to find cash flow in such pricey markets with such low caps, like LA and Seattle. And we've invested in Florida, but I have sort of a pause on Florida because insurance has gotten bad everywhere, but insurance has gotten really bad in Florida. And I think Florida is going to be a great market again, but for now, just kind of have a pause on it. So, very comfortable with Texas and Arizona, and just kind of again staying in my lane. I would be open to South Carolina, although I know that there's some property tax challenges there. The Carolinas are attractive, but yeah, in terms of what I stay away from, I the Midwest, it's cool, but you have weather challenges there that
And
can be
migration issues in the Midwest too. There's just
pretty
not,
flat.
yeah,
Pretty flat.
it's just not jumping off the page like some of these sunshine states are getting.
It kind of depends. I mean, Columbus has some positive migration, and Indianapolis, those are some pretty cool, healthy markets. But I agree. You look at this, it's negative population in a lot of those markets.
What do you think makes you most nervous with the recession coming up? Because it's likely right around the corner. I don't know how you feel about this, but I'm just ready for it just to be here,
Mhm.
and so we can kind of get through and see the greener pasture, not the hey, we're all waiting for the inevitable. We're seeing signs of it. I would argue we've been in it for some time, but just not officially out yet. I don't know if it's for political reasoning. That's a topic for another day. But what is getting you most nervous about, what's to come?
Well, first of all, I've been hearing about a recession since like 2017.
Yeah,
So I'm still not convinced it's going to happen. And you get these strong employment numbers, although I'm hearing that we're going to have quite a surge in unemployment toward the end of this year. So it may happen. But I think what makes me most nervous is kind of investor sentiment, not so much with regards to the stock market, although the stock market, it 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 uh it infiltrates the real estate market, right? You see the stock market heading south, and all hell breaks loose everywhere in people's minds, where that really may not be the case. But I see a lot of nervousness and people holding on tightly to their wallets right now, which is counterintuitive to the whole buy low, sell high. I mean, this is the window, right? We're entering that window, and that window is going to last a bit. And I have a sense that people are nervous, whether they're being, they're reading the general headlines on the news, or maybe they've heard some things with private equity. I hope people kind of get the message that that spells opportunity. Um, I'm not too concerned with, look, we survive recessions. In terms of multifamily, yeah, bad debt may increase, collections may increase, but you keep churning those tenants, and we can get through it. We got through COVID, so it certainly got not going to be the spike that COVID was. So if we could survive that, we're going to survive this.
Absolutely. And then I guess the other side of the coin, what's getting you most excited about, what's to come from an opportunity perspective? Because as you said, this is when everyone should be greedy, as Warren Buffett would say, be greedy while those are being fearful. What is getting you most optimistic and excited as we do, well, as we are really frankly in a transitional period of the marketplace?
Yeah, I think just taking advantage of a low cost basis. I mean, pricing is down. And from a current investment standpoint, that might be hard to hear as an investor, but hey, weather the storm, hang on to that investment, it'll be fine. Get into opportunities because they exist, just looking at the example of our current deal that we're doing together, price per door is down like over $40,000 per unit, 35% discount basically. Um, and there is the stress out there. Um, so but in general, I think that's what's that's what's most exciting. You could that's the real estate's a long-term play, right? If you get in a good cost basis, I do think interest rates, the rumor is 3 cuts this year. Hopefully that's a trend that continues. So not only are you looking at getting in a great cost basis, a great buying it right, you can look at into getting to better debt structure later on in the hold of the deal. You'll have that potential to refinance. So deals will only look that much better. Here you got a great price. In the future, you're going to get better debt. It's going to make for some really solid looking investments come 2026, 27, 28. I look forward to accumulating as much real estate now, and then just kind of reaping the rewards a few years down the road.
Absolutely. I think the cycle and the wave that will be catching up as a surfer, you can appreciate that. The wave we'll be riding as the market is resetting will be very fun, and definitely will be rewarding when we kind of see the equity creation and whatnot, and we play the game correctly. And the one thing I really want to voice my opinion on in a couple of years is when we do go kind of full cycle on these deals, is as well as we've done on these, let's be conservative and conscientious on what we exchange into to make sure that we can potentially hold a property during the entirety of a recession. Maybe we put on a longer debt, better debt at a lower rate where it's assumable to another buyer, where we can kind of flip equity and be in a situation that's beneficial, as opposed to not having a lot of options, which a lot of people are in right now due to the nature of the debt that they took. So that's definitely
Yeah.
something that I want to think about from a strategy perspective, especially when we go, do really, really well on these deals coming up, just from that perspective, just to, be reasonable and responsible with the equity that we created to make sure that it's preserved accordingly. Final thought, and this is the last question I like to ask everyone, is if you have any real estate hot takes. So if you need me to explain what that means, I can, but anything that's maybe contrarian or something that you truly believe to your core that maybe others do not.
First of all, you need like some music for this
Right.
segment.
Dun dun
You got
dun.
you got to get hot take.
Yeah.
Um, I It's probably not such a hot take, but I do follow the macroeconomics, and specifically how it pertains to multifamily. And people are like, "Oh my God, we're oversupplied," and we are, especially in markets like Austin and Phoenix, Dallas. There's a lot of supply coming on, but it's going to be very short-lived, and it's going to fall off a cliff at the end of well, probably within the first quarter of 2025, and that's only going to drive rent growth. So my hot take is get in while the getting's good, and that's probably for the next 4 quarters because we're going to ride that wave, like you said, because there's going to be, once again, a supply shortage. Um, and to get more granular, don't look at markets where there is a ton of competing supply. Um, to definitely get those absorption numbers and those forecasts. But that's my hot take. What do you think?
Very good. Awesome. Well, anything you'd like to plug before we conclude the show? Anything like that? Where can we find you? Where are your lead funnels for people to reach out to you and work with you potentially?
Yeah, well, you could go to fortressfederation.com/webinar dash replay, and you'll get sort of informative webinar on what our investment thesis is, some of the past deals that we've done, and hopefully learn a few things. And that, of course, is free. And you'll find a lot more stuff at our website, fortressfederation.com.
Perfect. Any other final thoughts before we end the show?
No, man, just that I had a great time, San Antonio. Thanks again for that dinner there on the Riverwalk.
Of course.
I love, that's one of my favorite things about this business is visiting markets and then hanging out with the team and really getting to know people on a human level. It was fun and much appreciated, my friend.
Yeah, no, absolutely. And Rob and I talk about this all the time, but there's a lot of competition out there. We're very much so humbled by the fact that there are great people that are out there and there are great operators like us who are doing deals. So we really feel as if this year is the year of doubling down on relationships, taking care of people, getting to know each other better, listening to what you want, what you need, and how we can be the best and first and class partners. That's really important to us. And just once more, a sincere, heartfelt thank you for your participation and all of the deals that you've done with us. We're, of course, doing a deal right now. We did a deal together last year, of course. So thank you for your participation, working with us, your thoughts, contributions. You're one of the first people I think about whenever need to have a reference on Lone Star Capital. So thank you so much for always being there for us. We look forward to seeing you soon, hopefully. I don't think you'll be in Race Fest because you've got another one on the way, which is very exciting. But hope to see you soon. Thank you so much for listening to the Fun Friday show. Everyone take care.
Right on. Thanks.